Hello, and welcome again to the Real Wealth Solutions podcast. I am one of your hosts, Greg Scully, joined as always by co-host Darren Light. Today, we are joined by Robert Beardsley of Lone Star Capital. Big fan of his, really enjoy his content online. He's also the author of, does this actually show up backwards when you do this in the camera, or do I see it backwards?
It looks perfect.
Yeah. The Definitive Guide to Underwriting Multifamily Acquisitions. It's a diminutive little book, but it's no fluff. It's got everything that you need there. Even if you're somewhat experienced, it's a great little kind of coffee table book to have available just to remind you of some things. And then along with it, he does have a calculator as well, which is free and available on your site, and we could drop that into the show notes. So if you're new to this or been at it a little while, I recommend both of those. But we invited Rob on today to talk about returns projections, more from a passive investor point of view. So maybe you're getting opportunities to invest in some syndications. We thought we'd kind of, I want to say digest, but that's the wrong word. We wanted to, look behind the curtain a little bit of what you might see in a pitch deck, and making sure that you have some understanding of how a syndicator may be coming to their terminal value calculation or their returns projections, and to make sure that they're in alignment with what you're after, and that you think they're reasonable. So with that, before I go too long-winded, Rob, can you give us a quick intro? What you're up to, where you've been, what you're up to?
Absolutely. So just to give the background on myself, about 3 years ago, my business partner and I, we founded Lone Star Capital to focus on owning and operating multifamily throughout Texas. To date, we've acquired over 1,500 units, again, mostly in Texas, but some assets in the Southeast as well. And we're continuing to focus those acquisition efforts both in the value add and the core plus space. So that means we're looking for properties where we see an opportunity, either through renovation or through poor management, where we can increase value, as well as find attractive cash flow, longer term hold opportunities where we see growth potential in a neighborhood and a property. So those are our strategies, and we raise capital from high net worth individuals as well as family offices and private equity firms. So we get a nice broad spectrum, a diverse group of investors to partner with, and we're always looking to meet new investors as well.
Right on. Just on that longer term horizon that you mentioned there, are you looking out 5 to 7 years, or 7 to 10, or is it kind of project specific, or do you kind of set every opportunity on one timeline and examine it from that point of view?
So the way that we look at deals is either through a 3-year hold or a 5-year hold lens. And so even if it is more so in the longer term hold strategy, we'll still underwrite it to a 5-year hold, with the idea that it's more so going to be a 5+ year hold, right? Whereas a value add deal, that's kind of a fairway value add, so it's not super distressed or opportunistic, we'll underwrite that to a 5-year hold, especially if it's financed with agency debt. But anything that's done with a bridge loan and is more of a buy it, fix it, sell it strategy, then we'll underwrite it to a 3-year hold. And something that we were discussing before we hit record was modeling in refinance into your underwriting, and how you're not a fan, I'm not a fan, just for the simple fact that there's no need to make your business plan and your assumptions more complicated than needed. So it's just good to keep it as simple as possible. And obviously a refi introduces a whole host of new variables. What LTV will you refi at? What cap rate will you refi at? What will be the interest rate, and things like that. So keep it simple. And if you are listening and thinking about, okay, well, I do want to refi in 3 years or less, what's the solution? In our opinion, the way that we approach that is simply just modeling in a 3-year hold. You'll likely be able to execute a refi before then. But the 3-year hold kind of models that business plan track of a short-term, a capital event within 3 years. And, obviously in a refi scenario, you'll still own the deal. So there'll be residual cash flow, but hopefully the cash out will be representative of kind of what a sale would potentially be.
Mm-hmm. And I guess the caveat to the bridge loan thing is if it's a massive lift, like you have to bring a building dark and then bring it back from the oblivion, and you're on a bridge loan, you're going to have some kind of a refi or an outright sale. So I would just add that. So yeah, so I'm a passive investor, and crack open my email and I see an opportunity to invest as a limited partner in something. By this time, the sponsor, all the levers have been pulled on debt, on the purchase price, the LTV, IO, things like that are non-negotiable. So those are set up, those are established in the pitch deck already. So when you're looking at these returns projections of whatever 13 to 15% IRR, 8 to 10% cash on cash, whatever they're bringing to you, we would just want to bring up some ways that you can reverse engineer or get enough information from the sponsor to figure out how are they arriving at these returns projections and whether or not they're going to meet your objectives as an investor. One of the things that is typically on the P&L is the rent increase, and expense increase could be decrease also. But the assumptions of what's going to happen with rents and what's going to happen with expenses. And we see this, for instance, in pro formas all the time. When you're going to purchase property, you'll get a pro forma from a broker, and they'll have a nice hefty 3 or 4% increase in the rents going over a pro forma, but you'll see a 0.5 increase over expenses. And over the length of a hold, that can be a dramatic difference in the NOI. So that would be something as a passive investor you could ask about if it's not presented. What are your assumptions on rent increases and why? And same with expenses. Anything you guys want to comment on that? Or did I do an unfortunate job of explaining it?
Well, I'm wondering if your question was more along the lines of, with Rob's experience, when you see all the levers that have been pulled, as we know it, and as some people know it, are there more that maybe we're not looking for? Or is there some diamond in the rough lever that a lot of people don't talk about that you see or look for, whether it's in management efficiency or otherwise?
Interesting. So yeah, that's a great question. And Greg, you pointed out kind of the low hanging fruit of using aggressive rent growth assumptions year over year compounds to a dramatic effect, like you said. And then the other ones that investors, once they kind of move past complete newbie, then they know about the exit cap rate, and they know to look out for that and to see that, make sure that that's within the realm of reality. And so those are kind of the two headline ones that I think people know. But to your point, Darren, there's some things that are kind of under the hood that are still ways to push the numbers further. And I actually recently wrote an article called the 6 ways to juice up your underwriting. And I really dug deep and wanted to go beyond the straightforward things that you see in every model that is, like rent growth and being aggressive with those types of things, but really under the hood things. And I'll try to remember a few of them, but check out the article. My favorite one, which it doesn't have the most massive effect, but it is still just kind of an interesting one when you uncover it. And so we all understand that terminal valuation is derived by taking some sort of NOI in the future and then applying the exit cap rate to it. And then there's your sale price, your future sale price. And so what's clear and obvious is what exit cap rate you're using, because it's going to be listed right there. It's going to be an assumption, and people can ask you for it. What's your exit cap rate? Oh, well, it's 6%, right? But what's more under the hood is, well, how are you actually calculating that terminal NOI that goes into that? It's the numerator of that equation. And so, the standard approach is to use, if I'm going to exit in year 5 of my pro forma, I should use the NOI from year 5. That would be basically the trailing 12 months of selling at the end of year 5. However, it doesn't always work that way. If you want it to be more aggressive, for example, what a lot of people do is they actually use a forward NOI, and they justify that in saying, well, a buyer's looking into the future and they're going to buy based on pro forma. And so I'm actually going to forecast my NOI out an additional year, and I'll use my year 6 NOI and then use a cap rate on that to derive my sale price. And so that would be a way just to kind of push the numbers a little bit further, right? If you have let's say a 3% rent growth, by doing the forward year, then you just boosted your sale price by 3%. And there's other ways you could do it too. For example, you could do T3 versus T12, which will have an impact. You could bifurcate how you're calculating income versus expenses. You could say, I'm going to use T3 NOI divided by T12 expenses. And so basically going under the hood is understanding how those calculations are done, which isn't easy. You have to, if that's your approach and you're actually set on looking under the hood, then you need to have access to someone's model, be able to get in there and unlock it, look at the reference formulas and things like that. And not a lot of people have the ability or the desire to do that. And that kind of gets to a major point that I like to make. And one of the big reasons why I wrote the book that you referenced earlier, which is the biggest mistake that passive investors are making in their underwriting, is that they're not underwriting at all to begin with. And that's, like I said, one of the big reasons why I wrote the book, because I wanted to make underwriting accessible. That's why I tried to make it a 100-page book, yet still comprehensive, where if you're even a pretty seasoned sponsor, you're going to get value from the book. But also if you're just a brand new investor that's looking to stay passive, but wants to be more sophisticated in their approach, it's a great way to get up to speed quickly on being able to crunch the numbers on your end and not solely rely on what the sponsor is telling you.
Yeah, I agree. I mean, yeah, going back to the book, I consider it to be a very conservative approach to underwriting, and how you decide whether or not something is conservative. You just, underwriting as conservatively as the book approaches, there's going to be a lot fewer deals that look like they are workable. But I have no problem with that, because it sets up your basis so well. I mean, if you're getting into a deal, hitting all of these parameters, doing the proper stress testing and things like that, then you're setting yourself up. At the very minimum, nobody wants to lose capital. Preservation of capital. You've done a fantastic job of making sure that number one metric is hit, which doesn't get talked about hardly at all. It's just like, that's what we're all here for, is to, first of all, not lose money. But yeah, great point. And about the 6-year NOI, yeah, that drives me nuts. I've seen that. Actually, when I was first getting started looking at some calculators, I got into like Udemy courses and stuff to build my own. And it got to the point where it was like that, when it was revealed that was how he was doing his terminal calculation, I just stopped. I'm like, that's not for me. I don't want to go down that road. But I brought that up in forums before, and certain people in certain camps will say that's the industry standard. And I think there's a half a dozen industry standards out there, it seems like. But yeah, good point about that one. I forgot about that one. It drives me crazy. And then, the exit cap rate, which you brought up, I like to see reversion cap rate. There can be instances where it can be flat. I mean, if you're the whole cap rate, that's a whole nother podcast, but just in a very general sense, I'd like to see underwriting that assumes that the cap rate is going to have some kind of revision, just as the safety net thing. It's a stress test. It's like, if this revision happens and it's written into our underwriting, then we're setting ourselves to perform to a stressor. And if somebody's buying at a 6 cap and in 7 years they're saying it's still going to be a 6 cap, that just raises my awareness a little bit of how this might not be as conservatively underwritten as I would like.
Yeah, and we also and we're talking about conservative underwriting and what does that even mean? And then we need to match that to reality and understand that, well, we can underwrite as conservatively as we want and pat ourselves in the back for how conservative we are. But at the end of the day, if we can't buy a deal because we're so conservative, then we're out of the market and we're not playing the game. And that's not what we're here to do either. So that's where underwriting stops being completely a science and becomes more of an art. And that's the higher level of underwriting. And that's where, how do we address the low perspective returns in everywhere in the world, and match that with investor demand, right? We have somewhat of an unrealistic investor demand just because of historical returns have been here. So people get accustomed to those returns, and now they only respond to offerings from sponsors that match that. Yet most sponsors understand that there has been a decline in those prospective returns. But so again, there's that mismatch. So how do we face the reality, still approach deals and underwrite them conservatively so we don't get in trouble? Like you said, first and foremost, capital preservation, yet still underwrite aggressively enough to actually win the bid and close the deal. And so that's where you need to find ways to smartly push the numbers without getting yourself into trouble. Again, doing the stress test. So, and one point I also wanted to make is there's two ways to approach it. You could say, okay, well, I'm going to be a conservative underwriter, and to adjust for that, I'm going to actually lower my return expectations. Instead of being like most people out there in the market and demand a 16% return, I'm going to be more realistic, and my return threshold is going to be 13%. And obviously, when I'm underwriting conservatively, that 13% is going to be a pretty great deal. The other way you could go is underwrite more aggressively, but raise your return hurdle. So it's really, you're ending up in the same place, but how you get there is different. So number one thing, like you said before, is making sure that the downside is protected. And then if you need to show a little upside in your numbers to make your investors happy, so be it, but know that the downside is protected.
Yeah, absolutely. So going back to more of the passive investor lens, let's talk about cash flows versus proceeds from sale, because you may get a few metrics from a sponsor that's saying your average cash on cash is this, your AAR is this, your equity multiple is this, your IRR is this. But if your personal investment objective is cash flow, you want to be able to examine that P&L or ask the sponsor just directly, what are the cash flows over time relative to the total return. So if you're in the point in your investment career where you're trying to do more of a replacement of income type thing rather than just investment to be realized at X over time, you may want to see a greater balance between cash flows over time and proceeds from exit. So that's one thing that you'd want to ask the sponsor specifically is, what is the balance of returns between cash flow and proceeds from sale?
Right. And there's a simple analysis called an Irr Partition, where you break out the cash flows associated with distributions, ongoing cash flows, and then also the proceeds from sale, the profits upon sale, which are based on appreciation, value creation through the business plan. So an Irr partition breaks up and calculates the IRR for just the cash flows, and then breaks up the IRR for just the profits upon sale. And this is it's a good way to look at it, because if you just look at simple numbers without using an IRR calculations that's going to take into account the time value of money, it's going to really sway into the sale profits, but those are far into the future, and so they need to be discounted to present value as such, whereas cash flows come sooner and regularly, and so the Irr partition treats them a little more favorably. So basically, like you said, it needs to match your goal, and I think a value add deal with reasonable cash flow is going to have 60% of its IRR come from cash flow, which is terrific. But hard to make a deal work when your underwriting isn't projecting such a big bump at the sale. So yeah, it's a great idea to look at that and kind of decide, sanity check a deal a little bit and say, okay, well, do these numbers make sense when you look at them this way? And, you know, can I be happy with the returns if all I get is the cash flow?
I've never heard that term, and that's amazing how you defined it. Talking about cash flow being this is not your quote, but something along the lines of the cash flow being present day value as opposed to in the future more your proceeds. So that's why you have the two different ones. Is that something built into your calculator or something that's an option in your calculator? I know in this recent deal we're doing, which is a syndication, we have them broken out, but nowhere like we show a separate IRR partition value for each one of those.
No, we didn't. We just talked about it kind of like I did. It's like, hey, here's your
Yeah.
cash flows you're receiving year over year, and they're just shown in real numbers.
To Rob's point, simple numbers.
Yeah.
But that makes, wow, that's awesome.
Yeah, and on my in our model, the sensitivities tab has just a tiny little percentage where we take the IRR partition and then we just simply calculate it as a percentage and say, okay, well, what percentage of this IRR is made up of cash flow? And that's really, it boils it down all to just that number.
That's great.
And the other thing I would add is, I mean, there's deals that are pitched to investors that have fantastic returns, but depending upon the market that they're in, there may be little to no cash flow for the length of the hold. And so I mean, sometimes there may be a tendency to bite on the marketing. That, you know, you see these fantastic returns and you're like, oh, I need to get into that. But under closer review, you may realize that you might not have the appetite to have the entire return component of this deal be at proceeds from sale 5 years down the road. Just from a risk perspective, is like, am I willing to just basically cut this check and then wait 5 years in the hopes that you know, this business plan works out? So
yeah, and you see a lot of, and not to disparage anyone's marketing, but you see a lot of deals being pitched with average annual returns, or average annual AAR, instead of IRR, which IRR is just industry standard throughout all private equity investments. And obviously it's a more robust calculation. It factors in the time value of money. And so what's interesting is when you see a deal that has all the profits backloaded, like you said, to the sale that are out in the future, if you do an average annual return calculation, it's not going to discount the fact that all the returns are coming from the back. And so it might be a 20% average annual return. But then if you run an IRR calculation, it's obviously going to discount those future cash flows, and it might only be a 15% IRR. And so there's the difference, right? And so depending on what your deal looks like, it may not be beneficial as the sponsor to market your IRR at all. Just keep your IRR to yourself and only show the AAR. But that's so it's another way to kind of look at and examine a deal and see if you've got a really high AAR and then a much lower IRR, that tells you right off the bat that the deal is banking on the future sale, which, like you said, can still be a fantastic return. It doesn't mean that there's any flaw in the deal. You just have to be prepared and expect that. And then the nuance there is, what is the reason for the deficiency of the cash flows? Is it because you're paying a really low cap rate because you're in a fantastic area, right? Are you in a high growth submarket of Phoenix or Denver or Dallas, right? And that's why you're paying a 4 cap on the hopes or that it's going to grow into that cap rate and you're going to have 3, 5, 6% rent growth year over year? Or do you have deficient cash flows because of the business plan? Are you buying a half vacant property? If that's the case, that's a different type of cash flow deficiency. And hopefully through the business plan, it can be remedied over the course of 12, 18, 36 months. So it's good to understand what's driving the low cash flows, right? And so for me personally, I'd be, even though I would say objectively there's greater risk in a deal that has low going in cash flow due to high vacancy or low rents and basically management upside, I would take that deal over just buying in at a low cap rate and just letting and hoping that the market will bail you out. That's just our personal preference as far as investing.
Yeah, that's a great point, because we've seen some of that happen just in the past year. What were traditionally extremely strong markets are now seeing much higher vacancies. San Francisco's and places like that, you know, 16 months ago looked completely robust and unshakable, are now seeing some flight. And some of those pro formas that may have been banking on rising with the tide instead of a true pushing of NOI through renovation might be hurting a little bit. Hey, it's Greg from Real Wealth Solutions. If you'd like to know more about our passive income opportunities, jump onto realwealth.solutions and hit that schedule a call button. We're always happy to talk about our multifamily and flip projects and to answer any questions you may have. Again, that's realwealth.solutions. We look forward to hearing from you. And now, back to the podcast. What about pref? So most of these deals you're seeing with some kind of a pref, 7 or 8 pref. I get this also ties into the cash flow thing. So it may be advertised that you're getting some kind of pref, but will those prefs be delivered on early? And it could be for some of the same reasons. And if they're not delivered on for the earlier part of the hold, how are they accruing in the meantime? Are they accruing at the same pref rate or not at all? So that would be another thing to ask as a passive investor is, what are the parameters around a pref deficiency? You got anything you want to add to that, Rob?
Yeah, it's funny. I recently created a video calling out preferred returns, and the gist of it was all preferred returns aren't created equal. Like you mentioned, there's some preferred returns that accrue and compound, some just accrue and don't compound, some may not accrue at all. And further, some may allow the sponsor to participate in the cash flows above the pref, whereas other prefs don't. And they have the priority of payments is pref, satisfy the pref first, return all the capital to the investor second, and then the sponsor gets to participate. Neither is right or wrong. We've done both, but certainly they each incentivize the sponsor and the deal to act a certain way. And just to give a quick summary of that, if you do have a more institutional style preferred return, which really acts more like an IRR hurdle, which the priority of payments again is the preferred return is paid, and then 100% of the capital is returned back to the investors, and then the promote kicks in. In that sort of deal structure, it's nearly impossible for the sponsor to participate in the cash flows, because how do you return all the capital just through cash flows? It's even difficult to return all the capital back to investors through a refi, right? You'd have to really hit a home run of a refi. So what that really leaves you is a sponsor who's highly incentivized to sell and sell sooner, because the sooner you sell, typically you can achieve a higher IRR, and then that allows them to dip into the promote. And furthermore, if there's a secondary hurdle, like if it's a 30% promote over an 8 pref, but then it's a 50-50 over a 15, for example, then selling quickly and then hitting an IRR in excess of 15 is going to allow the sponsor to get 50% of the profits above and beyond, rather than just 30%. So, so while that's a great structure for investors where it protects them because they don't pay any carried interest to the sponsor before they see all their money back and their pref paid, they have to understand that in that structure, they may have that downside security, but they are working in a deal where the sponsor is likely going to sell. So if you're a cash flow driven investor, it may not be the best option.
Yeah, there was a lot there. I don't know. Passive investor can completely get their hands around that one. I had a little trouble keeping up with you.
I've got this is weighing on me, this question. I've got to think that in the 3 years you've been doing this with a partner, you have evolved the way you do everything, and you got to a certain point and you thought, you know what, my investors are becoming more sophisticated as far as knowledge and wanting to know. I want to do this because no one's just going to add value to the industry, but I want them to truly know that they can have all their questions answered just by referring to this book. Because I mean, you're like, I'm to be frank, I respect Greg to the nth degree about underwriting. I'm not the underwriter, so that he's totally geeking out, but I know enough to know, my gosh, this is jam packed. So back to the book, was that the reason that you just saw this need? So because you wanted more people to understand, especially your investors?
Absolutely. I mean, it's not a selfless act like you said. Definitely, I'm acting in my self-interest with where, like you mentioned, I want to educate my investors and empower people to look at deals, and so make them feel comfortable and trust when I share them a deal. They don't have to just take my word for it. They can look at it themselves with the tools that I've given them and see for themselves if it's a deal that they feel that makes sense for their portfolio. And then also looking back at my journey and seeing when I started, there really was no sort of reference manual or how to step-by-step guide out there that I could find. And so I felt that was such a surprising thing given how important what we're talking about is. So I told myself that, okay, once I figure this stuff out, I'll just go back and write a book and put it out there, because so many people had been over time reaching out to me and asking me, well, how did you learn? Surely there was some course or book that you read and now and there wasn't one thing that I can point to as to how I learned. So now I'm really glad to be able to point people in this direction.
So you said your partnership formed 3 years ago. Were you already looking at multifamily prior to the 3 year, when that 3 years ago, I mean, like 4 or 5 years ago, is this something you were already educating yourself on and considering as a type of business or investment?
Yeah. I was working with my family. My family's background is in residential real estate. So single family, selling luxury homes in California, doing flips, doing development. And, I was doing my own research as well and discovered multifamily. And that's where I kind of pulled my family into the multifamily business away from single family. Said, no, this is where we need to be. This is where the long-term wealth is. Short-term wealth, sure, you can maybe make that in single family, but cash flow, tax advantages, long-term wealth, that was all really exciting stuff in the multifamily space. And so started, raising capital and doing deals with my family before going out on my own and starting Lone Star Capital with my business partner.
I love that. I love the fact that you pulled them along and you were able to help them see the light, so to speak. That happened to me. I think that happened to Greg in some shape, form, or fashion as well, getting away from single family. So I didn't mean to go down a rabbit hole there, but it's just churning in the back of my mind. So thank you.
Yeah, because the book is great, or just the kind of knowledge that comes from a book like this, or through your own self-education. Because, I've looked at limited partnership opportunities and other people's syndications and looked at their pitch deck and their OM and was completely unable to back into some of the assumptions that that were presented. They would come up with these returns and they would show you some NOI stuff. And I'm like, I cannot figure out how they came up with these figures. And it's not necessarily that is, in and of itself something terrible, but it gives you the opportunity to at least recognize that there's something maybe missing. And that's how I approach a lot of things. I read an article or see statistics. I'm a lot of times I'm just like, what is this not telling me? What's missing from this information here that would tell more of the story? So, it gives you the opportunity to get some knowledge, to try and back into some of these things that you're presented with, to understand them. And if you don't understand them, ask the appropriate questions so that you could further understand it and make an informed decision. Because I think we're all susceptible to marketing. As cynical as I am about marketing, I'm sure I still fall for it all the time, depending upon if I'm hungry and I see the right hamburger advertisement, I'm probably going to buy that hamburger. I mean, that's basically what happens. You see something that you identify with or want to achieve, and you start looking at it. but I mean, the hamburger analogy is not the best one because I don't know how to turn that into more of a multifamily type thing. But I think you get what I'm saying. What kind of stuff do you share with your passive investors? If they come to you and they say, like, "Can I see your underwriting?" How far do you go with that, or yeah, just we'll
Yeah,
drop it there.
absolutely. Yeah. So what we do, what we make available is we call it a deal room or a data room, and it'll just be a Dropbox where we'll have our underwriting, the historical financials, property tax information, could have debt information in there. It'll have the investment summary, and so really more than what most people want will be there. But I think it's good, and that deal room doesn't differ from. It's the same deal room that we share with prospective institutional partners, right? That really want to know everything and have the capabilities of fully analyzing all that material. So, really what we make available to passive investors is the same thing. And I think, first of all, the idea of not being willing to share your underwriting to a potential investor just makes absolutely no sense. So just a few ideas on that. A lot of people ask me, or they, confidently tell me that I'm an idiot because I don't sell my model for $200 or $500 or whatever it is. And I just can't wrap my head around selling my model when, if you're a potential investor of mine and you ask to see information about my deal, I'm going to share with you my underwriting model. So how could I charge that where I'm just giving it away for people who just want to see the deal? I just, that doesn't quite match up to me. But yeah, the idea, if a sponsor isn't willing to share a model with you, I just can't see a good reason. And they'll obviously say, well, we have something proprietary about our model that precludes us from sharing it. But that I've never seen a model, and maybe because it is proprietary, but I've never seen any model that blows me away so much and says, wow, I'm holding on to gold here, and I shouldn't let anyone else see this. It's so magical. I mean, underwriting is it's simple math. We're not talking about anything crazy. So that I don't agree with. So I think it's very important for investors, if they want to see the model, they should see the model. But also, a model is very helpful, but it needs to be coupled with the historical financials, right? The seller's T12 and rent roll, or else we don't really know what's going on. If I'm showing the historical numbers or the trailing numbers of an NOI of $1 million, and then I'm projecting that the year one NOI is 1.2 million, that may not be completely crazy, but what if that million that I'm underwriting on the trailing isn't exactly $1 million and I've made some adjustments and changed some things up? Or what if my model doesn't even show the trailing? So all you see in my model is year one, 1.2 million. Well, I have no idea. Are you doubling NOI? Is it the same? So you really need to understand what the base scenario is and then how you're projecting to build it. And so I think that's crucial stuff if an investor wants to dig in.
Yeah, that's a great point. I mean, sharing stuff that is relative to your pro forma. So showing people's pro forma without showing the basis for your assumptions is a little inauthentic, I guess or it's certainly not as transparent as it could be to just say, here's the data that I worked from to arrive at my conclusions. Take from it what you will. I mean, either agree with it, different, whatever, but at least that information is available for them to digest and look over. Because that's that's more information than I've heard anybody say that they make available to.
And Greg and I do that as well, but we don't. What I love about it is you've made it simple, just by, hey, here's the Dropbox, here's the
right,
Google
yeah,
Drive,
to go that far.
That's
usually it's like it's on request.
Yeah, we usually email it separately. But to your point, you didn't say this, but I'm thinking it. Us as deal sponsors or people putting the deal together, whatever you want to refer to us as, we, in every pitch deck we promote, do webinars on whatever, we have a disclaimer that says, do your own due diligence. How can we expect them to do their own due diligence if we're not providing that information for them? That's a great point.
Right. Yeah.
Yeah. And and like you guys know, the vast majority of investors don't want to do this work. They don't want to look at your underwriting. They don't want to look at the raw financials. They don't want to backtrack and understand how you derived your payroll assumption or your property tax forecast. The vast majority don't. But even if they don't dig in, just the idea that they've got this nice data room that's well organized and full of all this good material, I think that inspires confidence.
Oh, absolutely. Right. Yeah. Just the transparency side of it, I mean, would give me a very high level of confidence, even if I knew nothing about what I was looking at.
Totally agree.
Yeah.
And to add some more, and for the sponsors listening, I highly recommend that they do this as well. And some other things that I think are fabulous ways to build confidence and trust with investors is to start putting together case study Dropbox links or data rooms, right? So something that we recently compiled is we looked at some of our previous deals, and we grabbed the underwriting that we used at acquisition that we shared with investors to benchmark the deal. We bring in the pitch deck that we used to actually market the deal. And then we also copy and pasted all of the quarterly reports to date. So you could see, okay, here's how we underwrote the deal at acquisition. Here was the pitch deck. You can get a flavor for the business plan. And now here are the quarterly reports, and you can see how the business plan trended. And also our quarterly reports have budget to actual, underwriting to actual. So you could see every quarter how we're going. Our underwriting is here. Here's where the actual performance came in. And then here's our commentary on that, right? It's really important to base it off of your underwriting. And then, then we wrote up case studies actually detailing how the deal went and everything. So I think that's a really great way to walk an investor through a deal and say, okay, here's how we underwrote it. Here was the pitch deck at the time we marketed it. Here are the quarterly reports. And then here's a case study summarizing everything that's happened to date.
That's
yeah, that's
fantastic.
great, because you hear that all the time. People will share their, that they went full cycle on something and throw out whatever returns that they got on it. But rarely do they mention what their original projections were and whether or not they hit them or not. So that's I like that a lot. So, and because sometimes you don't always hit them, but a lot of times your investor will still be very happy, because they may understand that you presented with challenges that maybe were almost nearly impossible to project. But at the end of the day, if you preserved their capital and got them a return, I'm in the camp of anytime you make a profit, you've done something right, and you should give yourself a little bit of a pat on the back.
I think, as we've mentioned earlier, as we label ourselves conservative underwriters, but to Rob's point, there's a happy medium between conservative and aggressive, and showing a couple of different ways that you could go about doing that. But I think what you just laid out, having these case studies on your website or Dropbox, wherever you have them, to show others, can show that trend of, yes, oh, I've looked at 2 or 3 of these, and it seems they're a point or a point and a half above their returns for everything they've underwritten. That truly shows that you are a conservative underwriter. Because I think we get that question asked a lot. Hey, do you write this? And we try to make that comment a lot. So, it's always under promise and over deliver. So for what that's worth, I think that's a good thing to do, as well as show the level of confidence in what you're doing.
And you can also look and see how the returns, where the returns derive from. For example, if you see that the returns are mostly a result of cap rate compression, that's not bad. Investors are still making money. That's great. But it's far more compelling to see returns generated through NOI increase and a story, a business plan story to go along with it, and say, okay, well, we bought this thing at 80% occupancy. We had high conviction that we could lease it up to 95. We had X, Y, and Z comps to back that notion up, and we went and did it, right? That inspires a lot of confidence. Whereas, well, we bought it when the market was a 6 cap, and then now the market's a 5 cap, so we made a 20% return.
Yeah, Very, very
Right.
true.
It's
For
yeah.
virtually doing nothing.
I mean, yeah. I mean, you made a good decision, and luck was on your side. Maybe not luck. There were some tailwinds that you didn't generate for yourself that you benefited from, probably at a minimum. But yeah, to do it on a, like the value add plan, where you're like, we actually executed on a business plan for something that was underperforming, I think holds a little more weight for people, because they're like, oh, these guys are putting in the work and actually doing something, instead of just rising with the tide type thing. It's much harder to do. I think
Yeah, I mean,
that's lost on people sometimes. It's like, yeah, this is. I don't consider this an easy business. I enjoy it. There's a lot that goes into it, but to say that it's easy or anything, I disagree with that.
yeah. And if you look at historical returns, buying something in 2014, 2015, even 2016, when people thought that might have been the top.
Yeah, that was
all
the
those.
top.
Yeah, all those proved to be still fabulous years to buy, and there's nothing wrong with being right and on the right side of that tailwind, like you said.
Sure.
But it's just an interesting point. And another point there is lenders, when they look at doing a refi, they're very skeptical, and they actually don't want to lend additional proceeds against an asset if the additional proceeds is really justified solely by cap rate compression. That's a stated underwriting criteria of Fannie Mae and Freddie Mac, for example. They really want to see the justification for a refi at a higher valuation coming from NOI increases, so they can underwrite those cash flows.
Interesting. Yeah, I haven't heard that specifically, so that's interesting. Well, I know we're starting to get up to some time constraints, so could you leave us with your contact information, where we could find your book, Lone Star stuff, anything you want to leave us that we can also drop in the show notes as well?
Absolutely. So if you want to check out the book that we talked about, The Definitive Guide to Underwriting Multifamily Acquisitions, head over to Amazon. There's a print and Kindle copy. If you want to download the free model that you referenced, it's available free on our website, lonestarcapgroup.com. Actually, we upgraded. We have LSCRE.com, so a little shorter for you, so you can check that out, LSCRE.com. And on our website also, if you want to get in touch, feel free to just reach out to me directly or fill out our Invest With Us form, so we can get to know you better and see if you're a right fit for us.
Cool. Well, yeah, I think we talked about some stuff that passive people might be able to benefit from, and we touched on some stuff that I think sponsors can benefit from, and both of those are included in benefiting from the book. Really, I mean, it's a great little book to have handy for short, concise chapters. Sometimes I just read a chapter just to remind myself of what I'm supposed to be paying attention to. So again, thank you for joining us on the Real Wealth Solutions podcast. We always appreciate a comment, a review, and a share. If there's somebody that you think would benefit from this particular episode, we appreciate you sharing it with them directly. So thanks again. Darren, you got anything?
No, appreciate your time, Rob. Good stuff. Great stuff.
All right. Yeah. Thanks, Rob.
So much.
Appreciate it. We will see you all on the next episode.